let's get one thing straight. A lot of people say $1,000 isn't enough to start investing. They'll say the fees will eat you alive, or that you can't buy anything meaningful with it. Honestly, that's not true anymore. Zero commissions and fractional shares change the game. In 2025, that $1,000 is more powerful than ever. It's not about turning $1,000,000 into $1 million overnight. It's about building a habit and putting money to work. The biggest mistake with $1,000 is doing nothing. We'll break down the best options for every risk level. Alright, let's start with the absolute safest option. If it's a short-term goal or your emergency fund, capital preservation comes first. A high-yield savings account, or HISA, is your best friend. FDIC-insured up to $250,000. Your principal is protected. In late 2025, many HISAs pay around 4.0% to 4.5% APY. That's roughly $40–45 in a year on $1,000, risk-free. Opening takes minutes and gives real peace of mind. Think of it as the best parking spot for your cash. Rates can change if the Fed moves, but your principal stays safe. For nervous beginners, HISA is step 1, safe, liquid, and a solid foundation. If you want similar security but a locked-in rate, consider U.S. Treasury bills. You lend the government money for weeks up to a year. You buy at a discount and receive face value at maturity. For example, pay $9.55 now, get $1,000 back, a $45 return. Lately, T-bill yields often hover around 5%. Interest is exempt from state and local taxes. Best held to maturity, slightly less flexible than HISA. Buy via Treasury Direct or brokers like Fidelity, Schwab, or Vanguard. Institutions park cash here. It's safe, simple, and sophisticated. Bottom line, get your money back with interest, backed by the US government. Okay, let's move up the risk ladder a bit. If you can handle market swings for better long-term growth, look at ETFs. An ETF is a basket of many stocks or bonds trading like a single stock. Instead of guessing one winner, you buy the whole haystack. Beginner-friendly. Broad index funds like an S&P 500 ETF, VOO, or IVV. One share grants tiny stakes in the 500 largest US companies. Historically about 10% average annually, not every year. Returns vary widely. With $1,000, you can own a diversified portfolio in a few taps. Risk is market risk. Stay disciplined through downturns. Over decades, markets recover. Aim for a 5+ year horizon. Open a brokerage, transfer funds, search the ticker, place a buy order. That's it. You're diversified across America's top companies. Simple, low cost, proven for building wealth over time. Like diversification but not sure which ETFs to pick? Want US, international, and bonds, all managed automatically? Use a robo-advisor. Algorithms build and manage your portfolio. Leaders include Betterment, Wealthfront, and SoFi Invest. Answer questions about timeline and risk tolerance, conservative to aggressive. It creates a mix, like 90-10 stocks bonds if aggressive, or 40-60 if conservative. It picks low-cost ETFs, rebalances, and reinvests dividends. Typical fee, 0.25%, about $250 a year on $1,000. Set recurring deposits, dollar cost averaging builds wealth quietly. Perfect if you want a hands-off, disciplined, diversified plan. Now, the high-risk, high-reward path. Individual stocks. The upside can be huge. Just look at long-term winners. But for every winner, many stocks go nowhere, or to zero. This requires real research. Business quality, valuation, growth, and risks. Read filings, listen to calls, track the news. Use fractional shares, for example, $250 in 4 stocks to diversify a bit. Know your risk. This is a roller coaster versus the market basket. Many keep individual stocks as a small slice of the portfolio. You must be okay with possibly losing the entire $1,000. Treat it like hot sauce, fun in small amounts, not the main course. If stocks are hot sauce, crypto is the ghost pepper. It's the most volatile, most speculative asset class. Bitcoin, Ethereum, value tied to tech, networks, scarcity, and sentiment. Buy on regulated exchanges. Verify ID, link bank, purchase fractions. Upside can be astronomical, and losses just as extreme. Risk isn't just price swings. There are hacks, scams, and crackdowns. If you play, many limit allocation to 1 to 5%. Money you can afford to lose. Consider $100 for exposure and learning, not your entire $1,000. Go in with eyes wide open to the risks. There's an investment with potentially infinite returns, yourself. Use $1,000 for a skill or certification that boosts your income. A $5,000 raise is a 500% return, and it can recur yearly. Think digital marketing, coding, design, data analytics, or seed a side hustle. Editing services, pressure washing, real estate photos, crafts. A few clients can repay the $1,000, then it's profit. It takes work and follow-through, not passive, but in your control. Upside can be unlimited when you invest in your own capabilities. So, what's the single best way to invest $1,000 in 2025? There isn't one. It depends on your age, goals, time horizon, and risk tolerance. Here's a balanced sample. 60% ETF, 20% HISA, 10% stock, 10% self-investment. $600 into a low-cost S&P 500 ETF, your core long-term engine. $200 into HISA, safe, liquid, earning interest. $100 into a stock you've researched. $100 into a course to grow your earning power. Adjust to your comfort, more conservative or more aggressive. Most important, get started and build momentum today.